Think about this for just 1 second. Amazon is there, Google is there, Microsoft is there. These three giants control the entire cloud computing world. Now imagine a small developer or a startup that wants to launch their AI product. Should they spend hours figuring out AWS's complicated billing system? Should they get lost inside Google Cloud's endless settings? Or should they find a company that gives them simple, fast, and affordable cloud infrastructure without any headache? That exact gap is where DigitalOcean stands. Today we are going to talk about why this company's stock, ticker symbol DOCN, is currently trading roughly between $35 and $50, could be a seriously compelling investment to consider in 2026. First, let's understand what DigitalOcean actually does. It is a cloud infrastructure company, meaning it provides businesses with computing power, storage, databases, and networking services so they can run their websites, apps, and AI products on the internet. But what separates DigitalOcean from Amazon Web Services and Microsoft Azure is its focus. This company specifically serves small and medium-sized businesses, independent developers, and AI startups. When a new AI company is being built and a developer wants to launch their SaaS product, they do not want the complexity of AWS. They want the simplicity of DigitalOcean. Transparent pricing, fast setup, and an ecosystem that is built specifically for them. That is DigitalOcean's biggest competitive advantage, and it is not something that disappears overnight. Now let's talk about the numbers, because the story here is genuinely interesting. DigitalOcean generated $901 million in total revenue for the full year of 2025, which is 18% higher than the year before. In Q4 alone, the company brought in $242 million in revenue. But the real excitement is in the AI revenue numbers. The company's AI products reached an annual recurring revenue, or ARR, of $120 million in Q4 of 2025, which represents 150% growth compared to the same period a year ago. This is not just one good quarter. AI revenue has doubled for 5 consecutive quarters in a row. That is not a coincidence. That is a clear and sustained trend. Net income also grew by 207% in 2025, and management has guided for 19 to 23%. Revenue growth in 2026 is an even more ambitious 30% growth target set for 2027. But before you invest in any stock, you need to understand the company's actual business moat, what protects it from competition. DigitalOcean's moat rests on 3 things. The first is simplicity. Setting up a basic server on AWS can take hours of reading documentation and configuration. On DigitalOcean, the same task takes minutes. The platform is designed for people who want to build things, not spend their time managing infrastructure. The second pillar is pricing transparency. The billing systems of large cloud providers are so complex that businesses literally hire accountants just to understand their monthly bills. DigitalOcean has always offered flat, predictable pricing that a developer can understand in 30 seconds. The third and most powerful right now is AI infrastructure. In 2023, the company acquired Paperspace, which was an AI and machine learning platform. Following that acquisition, DigitalOcean launched its Gradient AI platform, where developers can run GPU-powered AI models, deploy AI agents, and scale inference workloads. This is now DigitalOcean's fastest-growing business line, and it is accelerating. There is also a macro angle here that makes this stock even more interesting in the current environment. In 2026, a significant portion of the software industry is facing real pressure. As AI tools like large language models replace traditional business software, companies that sell per-seat subscriptions are under threat. But DigitalOcean is completely insulated from that pressure because it does not sell software, it sells infrastructure. The more AI grows, the more compute power the world needs. The more compute power the world needs, the more customers come to DigitalOcean. This is a structural tailwind that is directly tied to the growth of AI itself. That is why, even as parts of the broader tech sector face headwinds in 2026, DigitalOcean continues to grow. This is not luck, it is positioning. Now let's talk about what analysts are saying, so you have a realistic picture of where the market sees this stock going. Wall Street has been consistently bullish on DOC. Goldman Sachs raised their price target to $78. Citizens set their target at $83. Cantor Fitzgerald gave it an overweight rating with an $83 price target as well, according to aggregated analyst data. The average 12-month price target across major institutions sits around $75, which represents approximately 35% upside from the current trading range. It is also worth noting that the company's price-to-sales ratio is currently around 7.3, which is still below its historical post-IPO average of 8.1, meaning that even by its own historical standards, this stock is not overvalued right now. Now let's be honest about the risks, because any responsible investor needs to hear both sides of the story. DigitalOcean's customer base is primarily startups and small businesses. And these are exactly the kinds of companies that cut spending first when economic conditions tighten. If a recession hits or venture capital funding dries up, DigitalOcean's customers will churn before the customers of larger enterprise-focused cloud providers. That is a real risk. The big players are not ignoring the SMB market forever. AWS has Lightsail. Google has simplified cloud tiers, and if they ever decide to compete aggressively on price and simplicity, DigitalOcean will feel that pressure. Third, expanding AI infrastructure requires heavy capital expenditure. The company is investing significantly in GPU capacity to meet AI demand, which creates short-term pressure on margins even as revenue grows. These are all factors that need to be part of your thinking before making any investment decision. So the final question is this: is DOCN a stock worth buying right now? Look, this is not financial advice, but the facts are clear. The company is profitable. AI revenue is growing at triple-digit rates. Analysts are bullish with price targets well above current levels. The company operates in a market that expands directly alongside the growth of artificial intelligence. Stock is currently sitting in a historically affordable range between $35 and $50. Well below the analyst consensus target of around $75. If you are looking for a mid-cap tech stock with real revenue growth, real profitability, and a genuine AI tailwind that is not dependent on hype, DOCN clearly belongs on that list. But as always, do your own research, understand your financial goals, and know your risk tolerance before putting any money into any single stock. If you found this video helpful, please hit the like button, subscribe to the channel, and drop a comment below telling me which stock you want me to cover next. I cover stocks like this every single week, affordable. It's fundamentally interesting companies that regular investors can actually consider. So make sure you hit the bell icon so you never miss an upload. See you in the next one.